Welcome to Chapter 5, Cost Volume Profit Relationships. This is one of my favorite chapters because it provides us with a lot of very useful tools to make decisions and predict costs and profitability for a company. So a lot of companies, when they're first starting out, are going to need to answer questions like, how many units do I need to sell to break even? How many units would I need to sell in order to achieve a certain level of profit? Should I rely more on variable versus fixed costs? What happens if I increase my marketing costs? Is it worth it to increase those costs by 10,000 if I can increase sales by, say, 1,000 units? And the list continues. All of those questions can be easily answered by utilizing the cost volume profit relationships that'll be discussed in this chapter. To simplify CVP calculations, managers typically adopt a few assumptions. So this is like one of the vocabs that you might see on an exam or quiz. And our assumptions are that the selling price is going to be constant, so the price for a product or service isn't going to change when volume changes. Costs are linear and can be accurately divided into variable and fixed components. And then in multi-product companies, the mix of products sold remains constant. So for example, if Apple sells 2 iPhones for every 1 iPad, that ratio of 2 to 1 would be consistent despite changes in volume. So those are the assumptions that we use in order for CVP analysis to work. Will those be true in reality at all times? Not perfectly, but close enough to give us answers that are relatively close to what actual results will be. So the first thing we're going to do is talk about how changes in sales volume affect contribution margin and net operating income. So this brings us all the way back to Chapter 1, where we learned about the CVP, or contribution margin income statement. So we're going to be going through an example for a racing bicycle company in this entire chapter. And we're going to use the contribution margin income statement we learned from Chapter 1 in order to apply CVP analysis. Remember, the contribution margin income statement breaks up costs by behavior. So we have variable cost and fixed costs, as opposed to a traditional income statement, which breaks up our costs into product versus period. Here we're focused on behavior, so that makes it a lot easier for us to predict cost at varying levels of activity. For example, at any level of activity, fixed costs should stay the same, whereas variable costs will change. So by segregating the costs into those two categories based on their behavior, we'll be able to predict costs at varying levels of activity. Remember that our contribution margin is first used to cover our fixed expenses, and then any remaining contribution margin contributes to income. For example, you could see the contribution margin of the company is $100,000. That covers the $80,000 in fixed cost, and then the remaining $20,000 contributes to income. What that means is effectively whatever happens to our CM is going to happen to our income. So if our CM were to go up by $1,000, we would have $101,000 for contribution margin. Fixed costs would remain the same, so our income would end up being $21,000. So if CM goes up $1,000, income goes up $1,000, because the only thing between contribution margin and income are fixed costs, which don't change. So knowing that's going to really help managers predict their profitability at various levels of activity, because again, the key concept is whatever happens to CM happens to our income. CM goes up $1,000, income goes up $1,000. CM goes down $1,000, income will go down $1,000. We can calculate our CM in total, which is what the 100,000 represents, or we can calculate it on a per unit basis. How do we get the per unit basis? Well, we could take our selling price minus our variable cost per unit in order to figure that out. Or we could take our total contribution margin divided by the number of units and get the same answer. So we know we're selling 500 bikes, So to get the 500 per unit selling price, we divide by 500 units. To get the variable cost per unit, we divide by 500 units. That gives us 500 and 300, which we subtract to get 200. Or we could have simply taken the 100,000 total CM divided by the 500 units, and we'll get 200 as well. Why do I want this on a per unit basis? Well, we're going to use the per unit CM for a lot of our calculations as we move forward. But very simplistically, what it means is for each additional unit we sell, $200 will contribute to our CM. And because we just learned that whatever happens to CM happens to income, I know that for each additional bike that we sell, my income's going to go up by $200. RBC needs to generate at least $80,000 in contribution margin in order to achieve what's called break even, which is when we make no profit. Now, of course, that's not my goal in life as a company to make no profit, but it's the minimum, right? I have to at least achieve break even in order to be successful in the long term. Initially, I might lose money as I grow my market share and introduce new products, but eventually I have to achieve that break even and then in the long term do better than break even so I can turn a profit. So for RBC, in order to break even, they need to sell 400 units in a month. And if they do, you can see that their total contribution margin equals total fixed cost, which will always happen at the break even point. So at break even, total CM will always equal total fixed cost. And we're going to learn a shortcut approach to calculate what that break even point would be later on in our lecture. But for now, just understand that we're going to break even whenever our total contribution margin equals our total fixed cost. And you can see that here, contribution margin's 80, fixed costs are 80, so our net operating income is 0, which is what break even represents. And as I mentioned before, because we know our contribution margin per unit is 200, if we were to sell one more bike above break even, that means our income is going to go up to 200, because whatever happens to CM happens to income. Notice my CM went up from 80 to 80,200, and my income went from 0 to 200. So whatever happens to CM happens to our income. If we sold 402 bikes, I hope you know that our income would be $400. If we sold 403 bikes, it would be $600. We're going up by the CM per unit each time. Whatever happens to CM happens to income. Did I mention whatever happens to CM happens to income? I think I did. We do not need to prepare an income statement to estimate profits at a particular sales volume, because if we understand these concepts we just discussed, we could take the number of units sold above break even by the contribution margin in order to determine our profit. So if we were to sell 30 bikes above break even for a total of 430 bikes, net income would be the 30 bikes above break even times the 200 per unit, or $6,000. If we change it to 500 bikes, which is what they were currently selling when we started off this example, then they're 100 bikes above break even, so we would do 100 times the CM per unit of 200, and that gets us our profit of $20,000. And if I scroll back, there it is right here. Racing Bicycle was making 20 grand when they were selling 500 bikes. So understanding how CM interacts with profit, that is that whatever happens to CM happens to profit, makes it very easy for us, and more importantly for managers out in the real world, to predict profits at varying levels of activity without actually having to recompute the entire income statement. In equation form, we can calculate our profit by taking our sales minus our variable cost, which effectively is our CM, and then taking away our fixed cost. So that's just in a horizontal format compared to the vertical format that we see in our income statement structure. If you read the textbook, maybe in the Smart Book, you'll see there are two methods to do a lot of the calculations in this chapter. One is what they call the equation method, which is based on this formula, and then the other is the formula method, which has a series of little formulas that help us calculate break even and profitability at different levels of activity and so on. I don't focus on the equation form. I think it's easier to use the various formulas that I'll present, but you can calculate it in either way. So through the Smart Book, if you find that you like the equations better, you're more familiar with algebra, you like it that way, then you might find the equation methods work better. I personally like the different formulas. I think they're short, easy to use, plug and chug, and get an answer, and hopefully you'll agree. So let's talk about a cost volume profit graph. I think this is a very useful thing to get an understanding of because it'll help you visualize how all of this break-even stuff works. You're not going to be drawing any graphs or any of our quizzes or exams, but you should understand how they would be prepared and some of the fundamentals I'm about to go over. So in order to put this in graphical form, we're going to take some data for our bike company, assuming they sell 0, 200, 400, and 600 units. To figure out these amounts, we take the number of units times the selling price, which was 500, and the number of units times the variable cost per unit, which was 300, and then the CM per unit was 200. So 0 times any of that is 0, and then our fixed costs are 80 across the board. They don't change. So 200 times 500 is where they get the 100,000. 200 times 300 is where we get the 60. We could go 200 times 200 to get the 40. And then the other way we could have got CM is to take 100 minus 60, which also equals 40. Let's take a look at the 600 level. 600 times 500 is where the 300 came from. 600 times 300 is where the 180 came from. 600 times 200 is where the 120 came from. Or 300 total sales minus 180 total variable costs equals that 120. The point of calculating these amounts at varying levels of activity is it's going to allow us to plot those data points on a graph. So we're going to start first by understanding what a graph looks like. You may remember this from junior high or even maybe elementary school, towards the end of elementary school, where we have a graph where dollars are on what we call our y-axis and units are on the x-axis. So we'll start by plotting our fixed cost. When we talked about fixed cost back in Chapter 1, you may remember it was just a flat horizontal line. And that's because it doesn't change based on varying levels of activity. So fixed costs are going to be 80,000 regardless of our activity level. The next thing we'll do is add our variable cost to that to plot our total cost line. So our total cost when we sell nothing is still 80 grand because we have our fixed cost to cover. And then it's going to go up from there because of the variable cost per unit. The slope of this line equals the variable cost per unit, which equals 300. So if we go over 100, we're going to go 100 units, we're going to go up by 300 times 100, or $30,000. So this dot here would correspond with 110,000. It would be the 80 fixed cost plus the additional 30 in variable cost. And that would be the same trend for every 100 units we go up, we're going to end up going up another $30,000. So this would represent 140,000 at this dot, and then 170, 200 right on the line, and then 230, and so on. So that represents our total expenses. The last line that we need to graph are our total sales. At 0, our sales are 0. The slope of this line is going to be our selling price, which is equal to 500 per unit. So if we go up 100 units, we're at 50,000. Another 100 units gets us to 100. Another 100 units gets us to 150, and so on. The break-even point is the point at which our total sales equal our total expenses. Why is this point so important? Well, because if we're above the break-even point, which remember is 400 units for our bike company, all of this up at the top is profit. Let me color code this for you. There's some beautiful profit, and that profit can go to infinity. Our loss area, on the other hand, is what happens if we're below break-even. We'll make that red. And our maximum amount of loss would be limited to our fixed costs. The most we could lose is our fixed cost, which is $80,000 if we sell nothing. So the break-even point is a very important point for a company because above it, they make money. Below it, they lose money. Another way to look at CVP relationships is just to focus on profit. So this is just a line that represents our profit for the company. And our profit, the slope for this line is going to be our CM per unit. So if we were to sell 400 units, we make $0 because that's break even. And then if we go down 100 units, you'll notice that we're decreasing by 20,000, which would be 200 CM per unit, 200 per unit times 100. So for every 100 units we go down, we lose 20. So 20, then 40, then 60. And then for every 100 units we go up, we're going to gain 20,000. So we go from 0 to 20 to 40 and so on. The lowest this is going to go, and they don't do a good job showing it because the entire graph isn't shown here, but this would go down a little further here, and that would be a loss of -80. That would be when we really sold 0 units, we would lose 80,000, which is our fixed cost. This can go on into infinity, and our profits could go on forever. Of course, it's limited in the reality by the number of units we could actually produce in our factory. So again, you're not going to be drawing any of these graphs on an exam or a quiz, but understanding the relationship between the various lines and when you make profit and loss when it comes to break even is extremely important. So hopefully the visual of the graphs help you better understand these concepts.